Be the most welcome for the Credit Suisse panel discussion. Is there a mobile around here? For the Credit Suisse panel discussion, the key topic that we have in mind is connecting capital with ideas. And it's a fantastic day today, so thanks for taking the time and coming here. I personally think it's a fantastic opportunity to meet with so many people like yourselves that have got ideas, growing businesses. From my business background, I used to be a lawyer, but then started investment banking some 20 years ago. What I really love doing, what I'm excited about, is taking companies public. So this is the opportunity to get to know companies very well and funding them with the needs to grow further. And I think this is something that some of you probably have in mind as well. Today, I'm very pleased to have a fantastic panel here for you. We would like to do that in the interactive way. We will start off with a brief introduction, panel discussion, and then open this up for questions as well. I think we've really a high-quality panel here, and I will introduce the team in a second. But let me kick off with a couple of data points just to trigger the discussion. Technology funding, private markets versus IPOs. Again, we're talking, I think, about rather late-stage companies, and here the big topic is how can you get equity to fund the next growth step in your career and in the development of your companies. We all know that seed financing is a big topic. However, we have seen a huge development over the last years in terms of private funding. When you go back to 2014, it was a massive development, really kickstarting not only the US, but also in Europe. The IPO market was on fire. Alibaba was in everybody's brain. 2015 became the year where the theme of the unicorn, the billion-plus transactions and company values, became the preeminent topic in the capital markets. At that time, we continued seeing quite a number of IPOs coming to market, to the public markets, but there was so much of capital available in the private markets that actually many of the companies said, look, I'm just taking another round. I'm waiting with the IPO till I've grown further. 2016, last year, was a very difficult year, not only for you guys, also for us on the capital market side, helping people like you becoming a publicly traded company. It was a year where investors turned a bit sour, the market development was poor, so it was much more difficult to raise the required capital. Today, actually, we're looking at a blue sky scenario. 2017 so far has developed as a key year. Credit Suisse, for example, took public Snap in the US, massive IPO, which was valued basically on a 2019-2020 outlook basis, which tells you that investors really are risk on again. You all know that Deliver Hero is in the market right now, and the start seems very promising. So I think really there's a lot of investor money and preparedness to invest into companies like you. Let's look at the various regions, and this is a topic that I'm being asked by a lot of companies. Where should we go public? Is there a value to go to the Frankfurt Stock Exchange or a regional stock exchange in Europe? When you look at the facts, obviously, and this is data since 2010, okay? Obviously, the preeminent machine is the US market, but what I would like to draw your attention to is that actually Germany has started developing quite nicely over the last years with the IPOs of Zalando and Rocket, Deliver Hero, so there's a number of floats coming to market now. The performance of Zalando, I think, speaks for itself. And Maggie Fanari, for example, over there, OTPP, she was an early investor in Zalando and can talk about that a bit. I think investors look for tech IPOs in Europe because there's a scarcity. There's a scarcity of high-profile, convincing equity stories that investors can invest into. There's plenty in the US, it's a machine. But again, when you look at Zalando, we generate nearly 50% of the investor demand, institutional demand, out of the US for a Frankfurt listing. So that tells you again, there's a huge demand for European listed tech companies. What are the key aspects that investors are looking for? What are the do's and don'ts? And probably this is something you've got in mind when you prepare yourself for such a round. What do we need to do? What will be critical from an investor perspective? Again, I don't want to talk too much about it. The panelists will do that from my perspective, but just a couple of key highlights here. What is the addressable market? What is your market position in your specific niche or market environment? Do you have a disruptive business idea? Are you a category winner? These are the buzzwords that come up immediately. And the more you can point investors to that and convince them with facts, the easier to get. What one, of course, should not do, you see that on the right-hand side, i.e. misprojections. You tried private placements a lot, it didn't work out. So things need to be planned very carefully and executed in a very professional way in order to avoid falling into any gaps. This shall be an interactive session, so let me also ask you a couple of topics. The first one is, who has experience with private placements? Can you please raise your hands, whoever in the plenum now has raised private placement money already? Is there somebody here in the plenum? One? Some more? So you're all still in the early growth phase? The second one is IPO. Is there somebody here who's done IPO so far? Experience? 1, 2, 3, 4? Who's considering to raise equity via private placement or an IPO? Do you need equity to grow your company? I've seen 1 or 2. Okay, so I think the session now is about making this even more attractive for you, because we up here honestly do believe that the private markets as well as the public markets offer fantastic opportunities for you, specifically for late-stage companies. There's a huge, huge willingness to invest in promising companies. There's huge liquidity in the market, both for private placements as well as for IPOs. So who do we have here? Let me start with ladies first. Maggie Fanari, here in the middle. Maggie is a senior director with Untitled Teachers Pension Fund. Probably don't know that much, but this is a huge investor in America, and obviously, like some other pension funds as well, they've got dedicated money for late-stage investments in order to maximize also their ability to participate in your growth. We've got Ed Cook to her left. Ed Cook has got a banking career and joined BlackRock some years ago, is now the co-head of global capital markets, and BlackRock is obviously key investors in private placements, but also in IPOs. Maggie was, for example, invested early on in Zalando. Ed has also backed up a number of large transactions, also IPOs like Energy, for example. Marc Lämmle, to the left of Maggie. Max is the founder and CEO of Fraugster, very successful and high-growth company, a huge machine that he is operating, and just did a private placement round with Marcus to his left, who is running our advisory business from an M&A and corporate finance perspective for the private bank. You see, Credit Suisse, we are organized with investment bank and the private bank. I think we cover more than a third of the global billionaires. And here, the interaction was of the private side. It's very important because these are entrepreneurs, people like you that would like to get exposure and would like to get involved. And Marc is really the link into that. Aliaksei, on the far left, he's my colleague who heads our private placement group in Europe, and he's on the road currently with a number of mandates raising capital for people like you. Myself, Joachim, I'm running our capital markets business for Northern Europe, spending most of my time, obviously, here in Germany, and I can tell you we are very busy right now. With that, let me turn over to the panelists, and again, up for you for questions, but let's ask me some questions first. Aliaksei, why don't we start with you? You're running private placements in Europe. Can you talk to us about what are the key criteria that investors are looking for, why private placement, and how do you do that?
Yeah, no, probably first start by defining what we call a private placement. So private placement is a bespoke process aimed at raising money for private companies and from investors in the run-up to an IPO. And these investors can be both financial and strategic. And from what we have seen, almost every discussion with an IPO candidate now involves a review of pre-IPO placement alternatives. Investors are interested in private placements because they give them ability to gain exposure to companies from segments underrepresented in public markets. Investors can spend more time with management teams and do a deeper due diligence. And structure and flexibility that allows to structure around their due diligence concerns and create a product. From the issuer's perspective, they find private placements appealing because they give them access to capital which may not otherwise be available via public markets. Private placements are very flexible and confidential processes. They can be structured around issuers' objectives. So, for example, flexibility around disclosure gives a better ability to communicate the equity stories for companies that are in the early stages of their development or that are going through a transformation stage. Ability to share forecasts is often very important as it supports discussion on valuation. most importantly, and we shouldn't forget that, private placement allow management teams to spend time with public market investors and start building their track record. So by the time the company goes public, many investors like Ed or Maggie will have met the company a few times, and hence it will be better prepared to make an investment decision, making your IPO a success.
Thank you. Maggie, from your perspective, I mean, OTPP has been a major investor in Zalando, and you have first-hand experience, not only from that, also from a number of other investors. When you listen to Aliaksei, is that also what you think about it? Do you have a different view?
No, I mean, absolutely. And we really did work with Credit Suisse around the time of Zalando. So, but private placements are a key pillar of our strategy, especially here in EMEA. From the perspectives of why we like private placements, it's really a function of giving us early access to management teams and allowing us early on to learn more about the company, become an investor. It also gives us higher conviction around the time of the IPO to come in meaningful size and support the company. So we really view it as a long-term partnership, starting at the time the company is really thinking about going public over a 12 or 18-month time frame. And really then building conviction over the long run. But that's really how we see it, is the private placement is the early innings for a very long-term partnership with the company.
Okay. When I think about OTPP, and I think you moved over to London a few years ago, Ontario Teachers Pension Fund, so perhaps as someone sitting here or myself some years back, you were quite surprised at pension fund. Why do you do private placements pre-IPO? Historically, OTPP was one of the, or still is, one of the big IPO buyers. But when did you change your view and came into private placement as well? And what was the reason driving that?
The strategy around private placements has actually been around for a long time. But it was primarily North American centric in the early 2000s, and really roughly around the time I joined Teachers, so about 12 years ago, we really started having much more of a focus on private placements, because what we realized is this created opportunities for us outside of the public markets to really come in and be able to have influence around a company and help them in their journey from going private to public. It was really an opportunity for us to capture markets where there weren't a lot of other participants, quite frankly, so the competitive environment was a lot less. But also, too, if you look at an IPO, you get one management meeting, you get a prospectus, and you've got a couple of weeks to make a decision. Meanwhile, through a private placement process, you're far more engaged with the team, you learn a lot more about the company, and you can really step in and become a 5, 10, 15% shareholder, because you've got that period of time really to do that. And then with respect to our private placement business, that was really a number of years ago quite focused on IPOs that were really, $5 or $10 billion plus IPOs, because you get a far more conviction around participating in those types of transactions because of the liquidity. Meanwhile, for IPOs that are sub 5 billion, you get a little bit less liquidity, so you need more certainty. And that's really, in order for us to participate in that part of the market, we really need to be able to do our work and form the relationships. And that's why the private placement process helps. But without it, it'd be much harder for us to do.
So it's really about trust building over time, following a company closely, and getting to know you better early on. Ed, BlackRock is a massive organization. I mean, you're seeing tons of companies coming by, presenting your investment case to you, big ones, smaller ones, late stage. BlackRock is a leading company also in terms of private placement, coordination, very important investor, and all of us, we've worked together many times before. How does the process work within BlackRock? And when you look at the companies here at NOAH, what are you looking for? What, in a way, boxes need to be ticked for you to be, and your institution to be interested?
Right. Thanks, Joachim. It's a pleasure to be here speaking to you today, and thank you for the opportunity. So BlackRock is quite a large organization. We manage just over 5 trillion in assets across a continuum of different strategies. So from listed to unquoted, from debt to equity, to be a big LP in VC and private equity funds, to be an active participant in the private equity markets. And so I'd echo some of the comments of the panelists. Is that our philosophy and my role is basically, in very simple terms, to be the football scout, to find great companies and bring them back to BlackRock, and we can finance you in a number of different ways and provide you capital. Is it private credit financing? Is it pre-IPO equity? Is it managing your cash? Is it providing you strategic solutions? And as I said, some of the times this is discussions that we're having for our funds and the funds we manage for clients. And some of the time it's for our own strategic partnerships. So 2 days ago, we announced a minority investment in Scalable Capital, which is a leading robo-advisor in Germany. Again, that's part of a partnership that we can empower a really interesting business with the distribution capabilities that we can bring to their business. So there's a number of different reasons why we sit here and try and build relationships with companies that are at a relatively early stage. Maggie's point is the right one, is that an investment decision is enhanced by a greater amount of time spent to really understand a particular company, its philosophy, its culture. We are predisposed to being a long-term investor, and we commit capital on a medium to long-term basis. And so for us, it's very important to get to know these companies over a long period of time, and less in a formal transactional process. So we were just talking on the stage, Delivery Hero, we must have met them, 12 times over the last 3 years, had a number of interesting discussions. We came close to investing a few times, but we now got all that information that we can take at the IPO, and that gives us a really important information advantage versus some of our competitors.
Max. Thank you, Eddie. Max, you're founder and CEO of Fraugster. You made it to the stage. Part of the reason for that is because you've been through a private placement round already, and very glad that you're here and that you join us. I think when I look at your career and how you've built up the company, now Ed and Maggie, I think also going forward will be interesting counterparts for you. How have you perceived the private placement process? I think this time around was more with the private bank of Credit Suisse, but going forward you're growing fast, so very happy to introduce you to the left, obviously. But how have you perceived the process? What are your lessons learned that you would like to share with the people in the room?
Yeah, so absolutely. I mean, as Joachim told already, so we are a payment security company. We have a super fast growth at the moment, and I think it's clear when you grow super fast, you need a lot of cash. And our fundamental belief is always that money should be the bottleneck of growth. That's the reason why we, in general, always open for new funding rounds. And I think that a private placement can be a very powerful and fast tool to hit these goals. And in our particular case, we wanted to work with ultra high net worth individuals because we had some really good experience in the past, and I think there's almost no one in the world who has a better network than Credit Suisse. That's the reason why we decided to go with Credit Suisse, but also we had beforehand relationships on the business but also on the private banking side. And what we did is, it was really that we said, okay, hey, we want to have investors who understood, on the one hand, our business. I think it's not really common in the investor scene that they directly understand our business, and then also that they share our vision, but also the passion for technology. And I think here we had a very good partner who was on the one hand the filter, so because you can imagine when you are, let's say, an attractive company that many people want to talk to you, but obviously it costs time, and here Credit Suisse helps us a lot really to filter that, and I think it was a very lean process. And at the end, we had a couple of offers on the table. We looked at them, and then hopefully we choose the right one. But it was a very straightforward process, so it was very helpful.
Super. No, thank you very much for that. Marcus, I mean, as I said before, Marc is our key guy in terms of corporate finance from a private banking perspective in Germany, and you were involved as well. So how, we talked about institutional money with Maggie and Ed, what about high net worth individuals, private banking money, like in the case of Fraugster? How does that work from a banking perspective, and what is really the demand? Because quite often people say there's a lot of talk, but not that much coming out of it. And I'm very glad, Max, that's different in your case.
I think the most important point is to understand that we have both as a bank. On the one hand, one of the leading investment banks, wealth management franchise, and that's why, as a Credit Suisse, we build up a corporate advisory team, being in private bank, build the interface between, the interface between private banking and investment banking. That means we support our private banking clients, which are founder of. Sorry.
We can manage.
I don't think it's working. Hello?
Yes.
Okay, now it's better.
Much
yeah,
better.
I hope you have at least heard something. No. Yeah, for us it's important to have both the investment banking and the private banking side, and my role is really to support young business owners as well as very major companies, entrepreneurs we have in the private bank, in all aspects of mergers and acquisitions, capital raising, and of course as well for special financing solutions. And if we think about the private banking network, then most of them are entrepreneurs. That's how they make the money, and that's where the passion comes from. And therefore, most of our private banking clients, we advise them in investing in a diversified portfolio of equity and fixed income, but they are pretty much interested to build some special investment opportunities around this portfolio. And that's exactly what we do. In terms of ticket size, we see two groups. One group is probably interested in smaller transactions, around 1 million into one ticket. But then we have, as mentioned, the ultra-high net worth individuals, which is a large group of clients of Credit Suisse, and they can spend around 20 million, 50 million, and we even had made the experience that they can spend around 100 million into one ticket. And yeah, I think that's a great opportunity for an issuing company, because you can really broaden your capital resources. And if you ask me, Joachim, about why should a private investor invest in a private placement and how do they think, then I would say they think quite similar to an institutional investor, meaning that of course they are looking for attractive opportunities with attractive economic terms, meaning they're looking for category winners, they are looking for fast-growing companies, but with a proven track record.
Thank you, Marcus.
Okay.
Look, I've got plenty of questions. I'm living this day and night. But I want to make this really joint effort. So let me open up and see if there's any questions right now that you would like to ask our panelists, institutional investor and entrepreneur, private investors. Any questions? Otherwise, I would certainly love to go to ask them. Going to the next question. Aaron? I think you have to speak up. Sorry for that. There we go.
Thank you. My name is Eran Davidson. I'm an investor for 22 years, venture capitalist. And my question to you guys, except Max, you all work all your life in big corporates with big, long tradition, and you keep telling us what you want to see in order to fit your needs. Learn the processes and be very close to profitability and be a billion-dollar company and so on and so forth, which means first you have to fit, we have to fit you, if I'm a startup company, to fit your needs, to adjust to your processes, to be almost risk-free in order to get your attention and funding. And now this is a very fast-moving environment we're in. And the reason I'm still in business is I'm trying to fit my solution to the needs of the companies. What are you doing to change your long, traditional, conservative approach of corporate DNA into the fast-moving targets you're hitting? Because it seems to me that you're completely disconnected. It's very nice to do Delivery Hero IPO, in which I was an early investor, but I took a huge risk, and you didn't. It's nice to do other deals you're talking about, but you don't take any risk, and you don't actually change anything in your habits to address the new needs of the market. What do you do to do it?
Was that a question to us or to Max?
And or Max?
No, Max is the only one which is not because he's the founder, right?
So I have a lot of empathy with what you just said. I mean, I think that there's a paradox in capital provision, and I think Max highlighted it, is that money and capital is kind of the easiest input to growing a business, because managing talent, building a customer base, enhancing technology, accessing a route to market, executing is a lot more complicated than just getting dollars in the door. And I think that what we've seen historically is a set of silos that someone like Max has had to knock on the door at different stages of his company's life to then remarket himself to a different constituency of capital providers. So family, seed stage VCs, late stage growth, pre-IPO, IPO, buyout, that is that continuum. Now, I think that what's interesting is that ecosystem is becoming much more intertwined. And whilst I recognize that we would not have the risk appetite that you do as a venture capitalist, we have a different portfolio construction exercise. Whereas a venture capitalist will take 100 Maxes and will be statistically betting that only 10 of them will work out. So that works well for the 10 Maxes that work out, but the 90 that don't have poured their life, their energy into that company, and your portfolio construction process has forced them to go for broke, if you will. So I do think that I recognize that we sit at a very different level of risk tolerance, and also we sit at a very different level of expertise. I'm not sat here going to companies saying, we're going to be an active investor on your boards, and I'm going to give you, help you recruit the next technology specialists, or to help infill particular problems that the venture capitalists, I think, are very good at, and that's part of their core skills that they bring as ex-entrepreneurs or have a very, complex network of expertise in that area. But I do believe that actually, when we look at it from an investment perspective, the capital is inconsistent, that Max has to continue reinvent himself to a different constituency of capital provider, and that you yourself are constrained by the investors that invest in you, that you have had to sell companies too early because you haven't been able to continue to finance their growth, because it doesn't fit with your wheelhouse of returns that your clients have provided you with. So my hypothesis is we need to be providing longer, more stable capital through that continuum, and that's VC funds going into extension funds or opportunistic funds, and that's us coming down going up that risk spectrum from our perspective to make sure that to entrepreneurs we have a much more seamless provision of capital. And I think that it requires for both of us to meet on both sides.
I would probably not echo that, because I think we have to give credit to ads and Maggie's institutions, right? They traditionally were investing only in IPOs, in public securities. As Joachim mentioned, we don't see many tech IPOs, so they were forced to move to earlier stage investing. And this requires a slightly different skill set. They need to spend more time with management, and they just don't have sufficient labor power. At the same time, some of those companies are staying private for longer, so they become too big for venture capital firms to continue funding them. So I think what we are observing at the moment is the emergence of new market, like we should call private placements, when traditional hedge funds and crossover buyers are starting to do illiquid investments. Some private equity firms, which traditionally were doing control deals, they're raising big pools of capital to do earlier stage minority investment. But also, venture capital funds are beefing up to continue supporting their companies as they grow and remain private.
Maggie, any additional view on that?
No, I mean, I think both Aliaksei and Ed have really summed it up, and it is about providing capital at different points in a company's life cycle, really. So.
Okay.
Those companies earlier than you it's kind of overlap with venture capital, I know, but they're very creative, innovative, exactly what they're asking you about, creating models for the changing demand. And those are hedge funds from New York. You know them.
Yes.
And you are not doing it.
Well, yeah, I mean, I think that what we have to recognize is that, there's a cyclical euphoria that was created in 2012 about late-stage growth companies, especially in the United States. There was a lot of capital deployed into it. And there's been a lot written in tech blogs about, asset bubbles and too much capital in a low-rate environment, people chasing growth. As I said, our strategy has not been to be one to chase cyclical trends, but to recognize secular trends in capital provision. So maybe we're not the first, maybe we're not the last, but what we're trying to build is something that's sustainable. And I think that that's core to the principles of what BlackRock is.
I think how we can summarize it, it's all about risk return. It's about what is your risk appetite. I think that's what you're alluding to as well. I think the institutional investors have made quite a long distance already. When you remember that originally it was more of an IPO investment style, now we see a lot of investments from large institutional investors into pre-IPO. I think when I put myself into your shoes as an entrepreneur, the key question I would also have is, what visibility on profitability do I need to have for private placement round? It's late stage private placement. So how tangible need the profit to be to excite people like Maggie or Ed? I mean, Maggie, is that something you would like to comment on? So what is the visibility you need, the path, so to say, to profitability when you're ready to invest into a company?
So I mean, when we're ready to invest, so let's take Zalando as an example.
Yeah.
I mean, that was a company that had decided that they would like to go and IPO their company within a period over the next couple of years. We didn't have a distinctive timeline, but we knew that it would be within a 12, 24-month period. That was a decision the company had made. And they had started making preparations for that, either from a governance perspective, in how they operated with respect to reporting, in how they thought about the various processes they needed, and so on. But from our perspective, a key tenet to all of this is the management team, and ensuring that that management team is one who is going to be able to successfully be the management team of a public company, because in many ways that requires a different skill set, and ensuring that they have the right people around them to support them. The second is for us, it's very important that that model has been proven out so that the core business itself is profitable. To give you greater confidence around the rest of the growth that they may be seeking. But really late stage to us, there is an element there of the core business itself being profitable. There's a strong track record of success, are really the key tenets for us, as well as an appropriate system of or framework for governance. But it's got to be of a size and point in time where the business model has been proven out. And that's a key tenet. And then we did see that over the time for Zalando. They were very early in their thinking around that and approaching investors such as ourselves And I think today that's really become a requirement in the public markets for when companies go to IPO and choosing the timing, that being profitable ensures a successful IPO in many cases.
Yep. Ed, before I come to you, Max, let me challenge you a bit on that. When you look at Europe versus the US, for example, and also taking Aaron's comment into perspective here, isn't it the case that investors in the US are a bit more risk on? For example, Google, investors telling Google, don't become profitable. We want to invest everything you've got in marketing to simply become the preeminent platform globally. Aren't the European investors or European-based investors a bit more careful with that regard?
That's a very popular hypothesis. I would counter that by saying capital is increasingly global. And there are just as many proponents certainly in our business that are sat in London expressing those views to certain companies. But I think it comes down to the points that, and I'm not sure I have really a strong opinion on the geographic divisions. I mean, it's something that's belabored in tech panels ad nauseum. I'm not sure I've got really a huge amount to add to that. But I would echo what Maggie was saying, is that the focus of what we look at is actually looking at the economic models of these businesses. And we've got nothing wrong with companies reinvesting all cash flow and almost burning cash. But what we are concerned about is, as you compound that, as you go for growth, there is certain models that have a decent amount of leakage in the model. And our sort of contention would be fix the funnel before you press the turbocharge button. And I think be very deliberate about when you're doing that. And I think that there are, if it's the junior markets on AIM or if it's the private placement arena, I think that there is an ecosystem of capital providers that are, I think, increasingly thoughtful, diversified away from the traditional sources of capital that are more predisposed to look at those kinds of challenges at that particular point of a company's life cycle.
Thank you. Taking that on board, looking to you, Max, in a way, you have been the entrepreneur pitching to investors. Would you share what you have viewed? Have heard any considerations on the interactions you have had? How deeply were investors pressing on your future profitability? How you're managing the growth of your company?
Yeah, I think we are in a very historical time. I mean, at the moment when you look at the statistics, I mean, we have more cash on the market as someone can employ it. Yeah? I think I've read a statistic that last year around 70 billion went to venture capital and just 50 billion get deployed. So this means you have a spread of 20 billion. And this, actually, we see this, yeah, which is a good thing for entrepreneurship, because I still think there is not enough capital in the market. And then I think also it depends what you really want. Yeah? For example, in our stage, is a BlackRock the right guy? Probably, I don't know how Ed is working, but they probably want to have a reporting which we would probably won't or don't want to deliver. Yeah? And I think for every stage at the company, you need a certain type of investor. Very early, you need a hands-on investor. Let's say growth stage, yeah, you need a different kind of investor, and probably at a super late stage, you don't need an investor who talks every day with you, or you don't want, because they probably don't understand your business. And from that side, I mean, I totally agree with that. And yeah, at the moment, it's a very good time for raising funds, I would say.
I think I would fully share your perspective. I think as a company, you really need to analyze in detail what are your capital needs and what state you're at in your specific growth strategy. And then you can see what investor fits best. Because this is also what I learned from you, Maggie, and from Ed, right? They're looking more for fairly professional companies that are late stage and where you don't need to spend a gazillion of time to simply track what management is doing. You do your due diligence before you invest, but it's not like you want to sit on their laps for the next years. You expect them.
This is much more about empowering entrepreneurs in a minority investment, which, as I said, if you feel that you want to self-control and you want to have private equity sat on your board and telling you what to do and managing you to through an exit process, that's a perfectly viable process. But as I said, the partnership that we foster with the portfolio companies that we end up investing in, there's a very high degree of cultural alignment. By nature of it being an unquoted investment, this is, I always say, this is like getting married, you know, and that's why you date for a very long time, because you've got to make sure that these are the right partnerships that you're striking.
Looking to you, do you have more questions you would like to ask our panelists?
One question from my side, Oliver Krause, Matchmaker Ventures and Arthur D. Little. I perceive, and you certainly have heard of it as well, that we see a lot of activity in the cryptocurrency ICO market, initial coin offerings. So my hypothesis is that this will completely change and disrupt the way capital is raised, especially in the early stages. What's your opinion on that? Where do you see the pros and cons, and how do you see that in the next years?
Who would you like to ask the question?
Whoever wants to answer that, so I'm free.
Right, I'll take a stab at it. So I can certainly see, so we're doing a lot of work with blockchain and centralized ledgers around, you know, bringing greater standardization and electronic connectivity to fixed income markets. And we definitely feel that that technology really could dramatically increase capital markets that is, I mean, woefully inefficient for a variety of different reasons. And actually, it would reduce a lot of the systematic risks that exist within that ecosystem. Naturally, a lot of that could flow to other capital markets. I probably, again, don't feel that I'm totally qualified to say in the early stage space whether there's really a need for that, because as I said, it's these things are less broadly syndicated. You know, as Max said, you know, especially your early stages, your investors are, it's a very personal relationship. So I just don't understand what would be the use case for that kind of technology. But I definitely think you're absolutely on the money in you know, on the credit side. We've got work streams, and we're trying to encourage partnerships with, you know, our banks like Credit Suisse to, you know, look at this technology, because I think it would help, as I said, help isolate a lot of operational risk that the market takes and counterparties take, and I think that it would bring greater efficiency to clients, and it would improve the capital formation process for companies looking to raise capital. And I think at a smaller end of the market, it then enables and empowers smaller companies to be able to access the listed debt capital markets or equity capital markets in a much more efficient form. And that can only be a good thing to diversify the sources of capital that companies can get access to.
Maybe one sentence to that. I personally don't believe in that. Yeah, I mean, I think investors who are working with milestones, yeah, are not. It's not working, yeah, because I mean, there's always is something changing, yeah, and if you have a fixed milestone when you work with a ledger like in a blockchain, yeah, what happens if you don't hit the milestone? You don't get the cash. I mean, totally stupid, right? So that's the thing. I mean, venture capital. I mean, maybe in a certain time or a certain category of companies where you can say, okay, when they hit milestone X, they get cash Y. But the reality is that I've never seen a company who started in seed stage or pre-seed stage give a business model or business plan to an investor that they hit the goals. So, and if you are starting with a blockchain solution, you would type in the blockchain or the goals very early in. So, and what happens if you don't hit the mark?
I just wanted to. Working? Yeah. I'm just curious about your perspective on that, because I was a little bit puzzled about recent, really very quick processes. We have seen, I think, like companies raising 150 million within 10 minutes or so. Yeah. So that's my hypothesis, that if we see that spreading beyond the core blockchain technology field, and we are seeing that in chat apps, Kik, I think, is the first outside that space. This would potentially disrupt the whole industry here.
Yeah.
Yeah.
So on that word, I would like to conclude our session here. I think you're absolutely right. I think not only your world is changing rapidly, also the financing world is rapidly. I think the ways how the capital markets are willing to support growth are changing dramatically, and I think it's an exciting time. Also looking at the market right now with a number of IPOs on the road, it's really a time where all of us, we can develop the future together. Look, the title of the panel discussion was Connecting Capital with Ideas. We hope this was an interesting and exciting 45 minutes for you. Thank you very much. Thank you very much to the panelists for coming here. It's great to have such a high quality panel with representatives of the institutional investor side, private investment banking, and on the company side, and private placement, distribution and planning side. Thank you very much for coming, and have a wonderful time here at NOAH. Thank you.